folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we'd come to you today with a brief market update, kind of let you know what's going on out there. Obviously, a lot of volatility in the marketplace right now surrounding what's going on in the Persian Gulf. To give you an idea, sense of levels, S&P 500 right at about 65.81. That is down about 4% year to date. That's down about 5.7% from its peak. And I want everybody to remember that 5.7% number because it's going to be important. It's going to come up a little bit later on. To set everybody levels elsewhere, the Russell 2000 is down about 0.5% year to date, about 8.3% from its peak. And the ACWI ex-US, which is really a proxy for all international stocks, is down about 0.2% year to date, down about 9% from its peak. And last but not least, I should also just mention bonds. Bonds, the Barclays Ag down about 0.8% year to date, down about 2.3% from the peak. Cushioning a little bit the impact of what's going on the sort of more large cap equity side, but still down a little bit due to some inflation expectations, which we will talk about. I will just note, the number one question that we've kind of gotten around, the current situation in the Gulf is like, what are we doing, right? Like, what are we doing to position the portfolios? What are we doing, to move things around? And I would like to remind everybody, we did extend duration in the portfolios late last year. We rebalanced the portfolios back on January 12th for those of you who are invested in the Bluemont portfolios or in the portfolios that we manage. That's really in preparation for this type of volatility in the marketplace. And I will just note that this type of volatility in the marketplace is really not actually that uncommon. I know that this particular cycle seems like it is more violent than the last. The media does a great job of producing scary headlines because they want you to tune in. But the reality of the situation is that we're not even down 10% off the peak, which is what we would consider a correction. We're actually down only about 5% for large cap stocks off the peak. That's something that happens on average 3 to 4 times a year. We get a 5% drop peak to trough in large cap stocks. So certainly not anything that rises to the level of, oh my gosh, this is a crisis, time to panic. And I would just note, even if we get to the point where it would be considered a correction, which would be down 10% off the peak, that happens every 19 to 24 months. So certainly not an unusual event. This type of volatility is actually somewhat expected in the marketplace. It is one of the reasons why we extended duration. It is one of the reasons why we rebalanced at the beginning of the year to try and address and prepare the portfolios for that. But on average, most portfolios should be performing exactly as they're designed to perform. The other thing that I would just remind people about this is that chasing volatility, chasing the zigs and the zags is exactly what we try and expressly avoid in a portfolio. If you look at Monday of this week, you saw a 2% move in the S&P 500 at the open. Based on a rumor that the United States might be, drawing to conclusion of, the hostilities, something that in our mind could happen at any time. It was a very vague goal that the U.S. Established when we got into this conflict, and so declaring when we're done with it is kind of anyone's guess. Because we don't exactly know when the administration will be satisfied or when the administration may choose to end all of this. And we also don't know what that might look like, in terms of restoring flow of oil, what that cost looks like, et cetera. And I just note, I had a couple of clients reach out to me and say, well, why haven't we bought oil? Depending on when you get into that trade, that could be a very painful trade. Oil was down 11% yesterday in the blink of an eye based on the cessation of hostilities or the idea that hostilities might cease. And so one of the things that we try and do, and I just want to caution people on, is when you're positioning a portfolio for long-term impacts, you want to be thinking about, or long-term performance, you want to be thinking about long-term impacts, long-term trends. So things like, where is the price of oil going to be, a month from now? Not necessarily something that you want to position a portfolio on. Things like, where is the price of oil going to be a year from now, 2 years from now, 3 years from now? Well, one could argue that it might be a little bit higher than it was previously because there might be some type of security premium that comes out of the Gulf. That might not be something that I'd like to bet on. But if we think about something like, the Pacific Rim countries being more prepared in the future for this type of shock, I think that is something that you might want to think about. So if you look at China as an example, they have stockpiled oil for years in preparation for this type of shock. They have been focused on electric vehicles and alternative sources of energy. And while that might not be the case globally, in the United States, we're energy self-sufficient, so we may not care as much about electric vehicles. You may see some of the countries around the Pacific Rim in the next, years, 5 years, 10 years, get a lot more focused on energy independence based on the reality of this shock, sort of, wakening them up to, the reality of their dependence on this particular region. The other thing that I think is safe to say, maybe a more long-term or intermediate-term outlook, is the outlook on inflation. The Fed coming out recently and saying, hey, until we see, some progress on inflation, you shouldn't expect to see any more cuts. That's actually moved interest rate forward curves to the point where the next expectation is actually a raise in interest rates, not a decline in interest rates. And I do think, based on what's happening with oil and how that will flow through the commodities chain, that's potentially a longer term impact that, we may see the inflationary impact of higher oil prices, flow through later this year into early next year. If you think about all the different things that petroleum goes into, all the different petrochemicals, et cetera, it's not just energy prices. It's involved in pretty much everything. So I do think a longer term bet on inflation might be appropriate. But when we think about like individual stocks or individual, bets on oil, et cetera, the thing that I would caution people on is you always want to think about like, well, what if I'm wrong, right? What if it reverses course dramatically? And how likely is that to happen? We want to avoid short-term moves, short-term positioning, short-term bets, because as yesterday kind of demonstrated, those short-term bets can go against you really, really quickly. And it's one of the reasons why we try and avoid or try and recommend that clients don't, time the market in that fashion. With that, as always, if you have any questions, please feel free to reach out to myself or your advisor. I hope you're having a great day, and I look forward to talking to you again soon.